Stop scrolling right now, because if you have a bank account, a checking account, a savings account, a CD, an IRA, literally any money sitting in any bank anywhere in the United States, what just got confirmed affects you directly. And the number at the center of all of it is $250,000. That's not a fine. That's not a fee. That's the number the federal government uses to decide how much of your money is actually protected if your bank goes under. And here's what millions of Americans don't know. The rules around that $250,000 just changed. The rules around how much the bank can charge you just changed. The rules around how much of your own earnings you actually get to keep just changed. The tax law, the overdraft rules, the deposit insurance structure, the debanking protections, the digital sign on your bank's website that tells you your money is safe, all of it has been updated, overhauled, or confirmed in 2026. And most people sitting in front of their banks right now have absolutely no idea. We're talking about changes signed into law by Congress and the President. Changes confirmed by the FDIC and the Federal Reserve. Changes that directly affect how much money lands in your pocket, how much the bank can legally take from you, and how much of your savings is actually guaranteed by the United States government, and how much of it is sitting there completely uninsured, completely exposed, completely at risk. This is not a scare tactic. This is not speculation. This is confirmed federal banking and tax law in 2026, explained in plain English, for real Americans who deserve to know what is happening to their money. We've saved the most important action step, the one move that could protect everything you've worked for the end of this video, so stay with us. And if you already know someone who keeps more than $5,000 in any bank account and has never once thought about the $250,000 rule, hit that like button right now so this reaches them before it's too late. Let's start where everything starts, with the most important number in American banking that almost nobody fully understands: $250,000. That is the standard maximum deposit insurance amount set by the Federal Deposit Insurance Corporation, the FDIC, for 2026. It means that if your FDIC-insured bank fails, if it closes its doors, if it goes under, if the government steps in and shuts it down, you are guaranteed to get back up to $250,000 of your money, not more. The FDIC has been insuring deposits since 1934, and since then, not a single depositor has ever lost a single insured penny. That is one of the most remarkable financial records in American history. But here is the critical phrase that most people completely misunderstand: $250,000 per depositor, per insured bank, per ownership category. That last part, per ownership category, is the secret that most Americans have never been taught. And understanding it could mean the difference between having all your money protected and having a significant portion of your savings sitting there completely exposed. Let's break this down slowly, because this matters enormously. If you have a single checking account in your name alone, $250,000 of that account is insured. If you have a savings account in your name alone at the same bank, the combined total of your single accounts is insured up to $250,000, not $250,000 each. They are counted together. That surprises a lot of people. But here's where it gets powerful. If you also have a joint account with your spouse at that same bank, that joint account is insured separately, up to $250,000 for each co-owner. So a couple with a joint account can have up to $500,000 in that account covered. And if you have an IRA at the same bank, that retirement account is in its own ownership category and gets its own separate $250,000 of coverage. Trust accounts add even more coverage. The FDIC insures trust accounts based on the number of named beneficiaries, and as of April 2024, the maximum trust account coverage was capped at $250,000 per trust owner. This means that one family at one bank using multiple ownership categories correctly can insure well over $1 million. But none of that protection works automatically unless you structure your accounts correctly. And starting March 1st, 2026, the FDIC updated its official digital sign, the sign that appears on bank websites, banking apps, and ATMs, to reflect these modernized rules. The new digital sign is not just cosmetic, it represents the FDIC's updated framework for how deposit insurance is displayed and communicated to you as a consumer in the digital age. When you log into your bank's app or website and you see that FDIC badge, That is now your signal to know that the institution is operating under the fully updated 2026 insurance framework. So, what should you do with all of this? Before you do anything else after watching this video, go to the FDIC website and use the free tool called EDI, the Electronic Deposit Insurance Estimator. It is free, it is official, and it will calculate exactly how much of your money at any given bank is insured and how much is potentially exposed. If you have more than $250,000 in a single ownership category at a single bank, you need to act on that information. Whether that means adding a joint owner, naming beneficiaries to create a trust account, opening a second account at a different FDIC-insured bank, or restructuring how your accounts are titled, the solution is usually simpler than people think, but you have to know the problem exists before you can fix it. Most people don't. Now let's move to the banking change that generated the most controversy of the past 12 months, and the one that directly affects you every single time your checking account balance runs low: the overdraft fee war. For decades, American banks have charged fees for overdrafts, situations where you spend more than your available balance and the bank covers the difference. The national average overdraft fee has historically been around $35 per transaction, and for millions of families living paycheck to paycheck, a single unexpected purchase could trigger multiple overdraft fees in a single day, turning a $12 shortage into a $105 bill by morning. The Consumer Financial Protection Bureau calculated that Americans were paying approximately $12 billion a year in overdraft and non-sufficient funds fees. In December 2024, the CFPB issued a landmark final rule targeting the largest financial institutions, those with more than $10 billion in assets. That rule required these banks to either cap their overdraft fee at $5, charge only what it costs them to run their overdraft program with no profit margin, or treat overdraft as an official line of credit subject to full lending disclosure laws and truth in lending protections. The rule was scheduled to take effect in October 2025. Then Congress stepped in. Republican lawmakers used the Congressional Review Act to move to overturn the CFPB overdraft rule, arguing it would reduce banks' incentive to offer overdraft protection at all and ultimately hurt the low-income consumers it was designed to help. The battle over this rule defined a significant portion of the banking debate in early 2025. Here is where things stand now in March 2026. The federal overdraft rule from the CFPB was overturned at the federal level, meaning the $5 cap did not become universal law. However, and this is critically important, the market pressure from that regulatory push already forced the nation's biggest banks to make substantial permanent changes. Bank of America reduced its overdraft fee from $35 to $10 and eliminated non-sufficient funds fees entirely. Chase introduced a grace period that gives customers until the end of the next business day to deposit money and bring their balance back to zero before any overdraft fee is charged at all. Wells Fargo eliminated NSF fees and introduced a similar grace period. These changes are now locked in as competitive policy. They are not going away. The banks made them permanent because losing them would cost customers. But here is the warning that still applies with full force in 2026. If your bank still charges any overdraft fee and you continuously overdraw your account, the bank will eventually close your account and report you to ChexSystems. A negative ChexSystems record can prevent you from opening a standard checking account at any reputable bank in the country for years. That is a financial consequence that is far more damaging and far longer lasting than any single overdraft fee. Know your balance. Set low balance alerts. Link your savings account to your checking account as a backup buffer. These are not complicated moves, but they are the difference between staying in the banking system and being locked out of it. Now let's talk about the one piece of federal law that is putting more actual dollars back in the pockets of Americans right now in 2026, and that the mainstream media has covered only partially. The One Big Beautiful Bill Act was signed into law on the 4th of July, 2025. A date the administration clearly chose deliberately. And buried inside this sweeping piece of legislation are specific provisions that directly affect your bank account, your tax bill, and how much of your paycheck you actually get to keep. Most of the bill's major provisions took effect on January 1st, 2026, meaning they apply to your current income and your next tax return. Let's go through the ones that matter most to everyday Americans. First, for workers who earn tips. If you work in a profession where tips are part of your compensation, restaurant workers, bartenders, hotel staff, delivery workers, and others, you can now deduct up to $25,000 of qualified tip income from your taxable income. If your modified adjusted gross income as a single filer is under $150,000 or under $300,000 if you file jointly, you may owe significantly less in federal income tax this year. For many service workers earning $40,000 to $60,000 a year, this change could mean a tax saving of several hundred to a few $1,000s depending on how much of their income comes from tips. This is real money. It is happening now. And a surprising number of workers who qualify don't know about it yet. Second, for workers who earn overtime. If you receive overtime pay, the extra half pay, the additional amount above your regular hourly rate that makes overtime time and a half, is now deductible up to $12,500 per individual, or $25,000 for joint filers, with the same income phase-outs at $150,000 and $300,000. This applies to W-2 employees in hourly and salaried positions, where overtime is documented on your pay stub and reported on your tax forms. For a nurse, a factory worker, a trucker, a construction worker, or anyone who regularly logs significant overtime, this deduction could be one of the most impactful financial changes they have seen in years. The deduction runs through the 2028 tax year, so you have time to plan around it, but the time to start optimizing is right now. Third, for Americans aged 65 and older, the One Big Beautiful Bill introduced a new senior deduction, a completely separate write-off from the standard deduction of $6,000 per individual or $12,000 for married couples filing jointly. To qualify, you must be at least 65 years old. You must provide your Social Security number on your return, and your income must be below $75,000 as a single filer or $150,000 as a joint filer. This deduction phases out above those thresholds. But for seniors in the middle income range, this stacks on top of the existing additional standard deduction for seniors, which itself increased to $2,050 for individual filers in 2026. A single senior with $60,000 of annual income could potentially be looking at over $23,000 in combined deductions before they pay $1 of federal income tax. If you are a senior, or if you have elderly parents and nobody has walked through this with them yet, this is urgently worth a conversation. The deduction is temporary and expires after the 2028 tax year, but for the next 3 filing seasons, it is there to be claimed. Fourth, and something that is going to affect millions of Americans who have car loans on vehicles assembled in the United States, the One Big Beautiful Bill also introduced a new deduction for auto loan interest on qualified American-made vehicles purchased after December 31st, 2024. The deduction phases out for single filers with income over $100,000 and joint filers over $200,000. This is not a rebate. This is not a credit at the dealership. This is an actual deduction from your taxable income for the interest you are paying on your car loan. If you financed a qualifying American-assembled vehicle in 2025 or are financing one now in 2026, you will want to ensure your lender is set up to provide you the correct documentation to claim this deduction on your tax return. Do not leave it unclaimed simply because nobody told you it existed. Now let's talk about something that affects every single depositor, every single business owner, and every single American who has ever worried about whether a bank might one day close its doors. The Debanking Executive Order. On August 7, 2025, President Trump signed an executive order titled Guaranteeing Fair Banking for All Americans. The order directly targeted the practice of debanking, the closing or denial of bank accounts based on reputational risk assessments, which critics argued were being used to effectively cut off individuals and businesses whose politics, religion, or legal industry were disfavored by banks' internal policies. The executive order mandated that all federally insured banks and financial institutions provide equitable access to financial services, with banking decisions based exclusively on individualized, objective, and risk-based financial analyses. It directed federal regulators to eliminate any guidance that could result in politically motivated or discriminatory account closures. It ordered banks to make reasonable efforts to identify and reinstate clients who had been wrongly denied service, and it launched a formal strategy through the Treasury Department to scrutinize and legislate against debanking practices going forward. For everyday Americans, this means something very concrete. If you have ever been told your account is being closed without a clear financial reason, if you run a business in a legally operating industry that banks have historically avoided, or if you are concerned about your right to access basic financial services regardless of your political beliefs or your profession, the executive order represents a significant formal shift in how federal regulators approach your relationship with your bank. The Senate Banking Committee's FIRM Act, which passed through committee in early 2025, aims to codify these protections into permanent law so they cannot be reversed by a future administration. As of this recording, that bill awaits a full Senate vote. Pay attention to it. Let's come back to interest rates, because this is the financial backdrop against which every single one of these changes is playing out. After cutting its benchmark rate 3 times in late 2024, each cut by a quarter point, the Federal Reserve is expected to trim rates 1 or possibly 2 more times in 2026. What does that mean for you? If you have a high-yield savings account that was paying 5% annual percentage yield or close to it back in 2023 and 2024, that rate has likely already come down and will probably come down a little further. The best high-yield savings accounts are still offering rates near 4%, which is historically excellent, but the window of truly exceptional savings yields is narrowing. If you have money sitting in a standard savings account at a big bank paying a fraction of 1%, the gap between what you are earning and what you could be earning at a high-yield savings account or a short-term CD is still enormous. Moving $20,000 from a big bank savings account paying 0.01% to a high-yield account paying 4% is roughly $800 a year in additional interest income for doing nothing except moving the money. Experts are also recommending that consumers with significant savings consider locking in rates now through longer-term CDs before the Federal Reserve makes additional cuts. Once rates drop, the window for those returns closes quickly and does not reopen until the next rate cycle, which historically takes years. Here is the action point we promised you at the beginning, the single most important step you can take right now in response to everything we have just told you. Go to the FDIC website, fdic.gov, and do 3 things. First, use the Bank Find tool to confirm that every bank where you hold an account is actually FDIC insured. This sounds obvious, but not every financial institution is covered, and non-bank financial apps in particular are a growing area of confusion about what is and is not insured. Second, use the ED tool to calculate your exact coverage at each bank. Input your accounts, your ownership categories, your beneficiaries. Get a precise picture of how much of your money is protected and how much is potentially exposed. Third, check whether your bank's website and mobile app now displays the updated FDIC digital sign that became required from March 1st, 2026. If it does not, that is a red flag worth investigating immediately. After that, if you are eligible for the tip deduction, the overtime deduction, the senior deduction, or the auto loan interest deduction under the One Big Beautiful Bill, talk to your tax professional or use updated tax software that reflects 2026 law. These deductions do not claim themselves. They require action on your part. And if you work with a tax preparer who has not proactively mentioned any of these new deductions to you, it might be time to find a preparer who is staying current. The American banking system in 2026 is more regulated, more transparent, and in several concrete ways, more consumer-friendly than it was just 12 months ago, but it is also more complex, more layered, more full of details that require your active attention rather than passive assumption. The people who benefit most from all these changes are the people who know about them. The people who lose out are the ones who assume that because they have a bank account, their money is automatically, completely, and permanently protected in every scenario. It isn't, not without understanding the rules. Your money built the life you're living. These rules determine how well that money is protected. Know them.